You are now listening to The Big Trade with Peter Pham, enlightening conversations for maximum market returns.
Michael, thanks for coming on to the Big Trade series. Why don't you introduce yourself to the audience and let everyone know what you're up to these days?
All right. My name is Michael Oliver. I have a sole proprietorship of Momentum Structural Analysis. I've provided proprietary technical research since 1992, primarily to asset management institutions, hedge funds, banks, mutual funds, and so forth. My focus is pretty broad in my reports, which I've now included retail clients can subscribe and go to the site, www.olivermsa.com. But my reports cover all four of the major exchange-traded categories. That would be equity, arena, commodities, interest rates or debt markets, and forex markets. I do focus a bit more probably on the equities and the commodities because there's more interest there, but I try to cross-correlate things. In other words, I don't just look at the S&P 500 in and of itself. It doesn't exist in and of itself anyway. And I look at the relationship between markets. I do a lot of spread work. Spread work is simply the relative performance of one asset category to another and so forth. And a lot of information can be gleaned from that. All my work is technical. I tend to block out fundamental input. I do have my own solid fundamental views, but I don't let them get in the way. Timing to me is more important than broad generalities. My methodology, to describe it in a couple sentences, is momentum structural analysis through emphasis on structure. A lot of people use the phrase momentum. You know, what a momentum player is a person who chases a trend. Well, I don't do that. I seek to anticipate trend change before it happens. I look for the evidence in the momentum action of a market. And by momentum action, I simply mean, we've all heard the phrase, I think Bob Farrell invented it, the technician at Merrill Lynch decades ago, who said one of his prime rules was, all markets will always return to their mean. Well, you know, a mean is an average, and, you know, there's short-term averages and there's long-term ones, so we're more concerned with the long-term stuff. For example, a 3-year moving average or 36-month. And if you go back 100 years in the S&P 500 and the Dow Industrials, you will in fact see that the market is more or less continually weaving above and below its mean. Sometimes it'll just return to it. Sometimes it will oscillate well below it. I think we're at one of those points right now, an inflection point, where we're about to go back down to it at minimum, which means the 1600s on the S&P. But I plot, instead of plotting price, like most technicians, I plot price in relation to, on an oscillator, various means, long-term, intermediate, and short-term. So I'm continually looking not just at trends, but various trends, because any market at any one time is engaged in a short-term trend, an intermediate trend, and a long-term trend, and they can be contradictory. And it's very important to know the difference, to know how they interface. So anyway, as brief as I can be, I think that sort of expresses what I do. Momentum structural analysis. I'm looking for structural breakage, trend change evidence, much like a price chart technician looks for in a price chart. I look for it in momentum.
So, Michael, if we were to take a look at the history, say, for example, of the Dow Jones or S&P over the last 100 years, like you indicated earlier, let's just take that whole sample of like the 100 years. If you're taking the mean number of that, or a median, for example, and you're talking about mean reversion, intuitively I understand that equity markets are continuously making higher highs, right? We're basically at all-time highs at this juncture. How do you define the time period? Because if you go too further back, then it means that you would have, right now, we'd be several standard deviations, I imagine, from the mean based on it being at all-time highs versus, say, 50 years ago or something like that.
Well, no, not actually, not the way I do it. I also, for example, I've put a lot of emphasis in since October through January on plotting the S&P 500 in relation to its 36-month average and its 3-year average. They're slightly different. When you plot them, they can reveal different information.
What is the statistical significance of the 36 months? How do you come up with that figure?
It's not really. argue that there is no magic average. There is none. It's all somewhat arbitrary, but you can at least define them in terms of one being long-term, one intermediate term. For example, if you use a 3-year, a 3-quarter, a 3-month, a 3-week, you lessen the magnifying glass that you're oscillating against. So if you're concerned about what's the S&P going to do for the next 3 to 5 weeks, what you should be plotting is not the S&P versus its 3-year average. That's a too grand of a view. You should be plotting it versus its 3-week average. And so it ebbs and flows on like a yo-yo on either side of that average over time. And you want to know when it's turning down to go for that average and possibly go through it.
So what if I'm using like a 4-year average? And I could argue that's like a presidential cycle or something like that.
Right. That's no less valid than a 3-year. It's somewhat arbitrary. I'll grant you that. In fact, I use a 200-week average, which is almost that's a 4-year average almost. It's very popular, the 200-day average. And I can oscillate against that as well. You plot the daily price and its relationship to the 200-day average. How much above is it? Or how much below is it? And it shows up as a plus or negative on an oscillator.
Sorry, did you say 200-week or 200-day?
Well, no, you can use either.
Okay.
Uses the 200-day, and frankly, my son, who's advanced some of my research, said 1 out of 200 weeks. So he went back and showed me about 90 years of stock history using the Dow weeklies and then the S&P weeklies, plotted versus a 200-week oscillator, which is about the long. I use a 10-year as well. But you can go out too far. But the main point being that the number itself, whether it's a 3-year or 4-year or 1-year or whatever, that's not really there is no holy average. It's not crossing the average that matters. It's the structures that are built when you plot the oscillator. You will see, perhaps I'll argue this point, you'll see more perfection, more structural integrity to the visible eye if you plot a momentum chart than you will if you plot a price chart. And you can have a situation where the price chart of let's say the S&P right now is continuing to ascend with loops and bumps and ups and downs and so forth, but a gradual ascent actually of the last 6 months. When you plot momentum against, for example, a 36-month average, it's flat as a pancake. The lows keep coming back to the exact same level, 340 some odd points above the 36-month average, which is uncanny. Ever since January, every low every month is between 340 and 350 points over the 36-month average on the oscillator. So if you looked at the daily price of the S&P, you see this ascending irregular pattern, really. You look at this oscillator and you see a perfect flat floor.
Now, Michael, let me ask you, if I was to, say, for example, I am following a particular market, ETF or equity, and I use this kind of like school of thought in terms of thinking, right? What happens when, for example, the price of the particular equity or ETF is going in a different direction from what the analysis is indicating, and then this is what happens to me psychologically in a situation like this. I would then start to then maybe adjust the analysis. So rather than the 200-day or 200-week, maybe because the price isn't working the way or confirming the direction after I took the position and I've become extra sensitive about holding that position, I'm then going to adjust it to like 100-day or 100-week average. Could that be possible? Doesn't that happen? And doesn't that put me in a less advantageous position because I've taken the position based on one form of analysis and kind of curve fitted it to,
Correct, yeah.
Give me some additional psychological support?
Straightforward couple answers there. One, always look at different time scales of trend. So, for instance, in October last year, the S&P dropped from at about 1960 in price early October. I put out a report and said, we're going to get hit hard. We dropped to 1820 in about 5 days. Why? Because the 36-month oscillator broke a major structure.
Right.
The 3-year oscillator did not. It held precisely at the October low. So you have to look. Not only is there not one wholly HOLY moving average, there's also not one wholly trend. You should always be looking at the intermediate to balance if you have a long-term view, because sometimes intermediate trends can hurt a lot. You may have a long-term bearish view on a market or bullish and suffer greatly in an intermediate counter-trend move. So you must always be aware of that and always be measuring the different timescales to fit them together. And sometimes they do fit together. And that's
So
when you
what
get
is
your
a
best
good
moves.
definition of long-term, medium
I'd
term, and
say
short-term?
Short term is something last measured in a handful of weeks. Intermediate is something measured in a handful of months. Quarterly is in between. It's a handful of quarters, and annual generally will dispense its trends within 3 to 5 years. So each of them tends to behave in a fairly regular clock-like manner, not cyclical in a perfect way, but the durations are, call it several years, several quarters, several months, several weeks. And those time frames, if you're concerned about the small stuff, then you should incorporate that into your view. But again, you mentioned one thing that I want to straighten out, that as far as momentum. You said when the price does something that momentum isn't doing. Well, that's what most momentum tools that you'll find on your computer screen, free of charge with the software program, that will give you overbought, oversold readings or will non-confirm the price action. I view non-confirmation, which is the most popular use of momentum out there, as a wet noodle aspect or attribute of momentum technical analysis. There are many times when a market may be pushing into a new high and its momentum indicators are not agreeing. Mm-hmm. You don't go short because there's a non-confirmation. You become aware that there's probably something about to happen, but the non-confirmation could persist for a while. That is not a good use of momentum. That's why I emphasize the word structure. If I see a non-confirmation, I make note of it. And it's probably a leading indicator. But it could be 3 weeks leading, 3 months leading, and it can be painful. What I look for is literally a snapping point where structure, a floor, a ceiling, a 5-point uptrend line, for example, on a momentum chart gets broken. It's at those points of breakage, regardless of the non-confirmation issue, that you get your whoosh factor, where the market suddenly moves from level A to level B very rapidly. Almost all moves in markets that are the sudden downdraft or updraft variety come from momentum breakage and possibly some price breakage, but usually momentum will lead it. And that's why I focus on momentum and the structure of momentum.
So, Michael, would you say that other individuals can replicate your approach, or because it's so ad hoc or bespoke to each individual, that the analysis and the conclusions that you generate might be different from, say, that of your son or someone else that's actually still using this whole school of thought, which is momentum structural analysis?
Probably anybody could interpret anything the way they want, but I'm very disciplined in the way that I interpret what structure is. It has to be abundantly clear to the point where a 12-year-old child with a crayon can see the structure just looking at the chart. The subjectivity factor, if there's subjectivity in the momentum study, I pass it on and go to another market. You don't have to play a hand of poker if you've got a bad hand. And if you do an analysis of any given market and you sort of come away scratching your head or sort of fudging your opinion like, well, it sort of looks like, don't do it.
Right.
Go somewhere else. It's the same would apply to a fundamental analyst. There's no reason taking a position if you don't have a conviction.
Right.
And so a lot of times momentum will be unclear, just as price will be unclear. But when it becomes...
Don't you think I could... Sorry, because these are very important points, and I think the audience will appreciate it too. Don't you think that even if you say you went with like a daily, a weekly, and a monthly, do you think that I could go with, like, I don't know, a bi-weekly, quarterly, and an annual, and find a complete, like, from my perspective, I could see a complete downtrend when you're seeing a complete uptrend because we're using different time frames. Kind of like long-term, short-term, and immediate term, but just different, like, periods, basically.
Correct. It's the magnifying glass. How big is it? What's your field of view? If you're only concerned about the next 3 weeks, the annual momentum structure or the trend of annual is almost irrelevant. If you're a trader, you're a short-term trader.
Right.
But if most of the big moves will come from the big trends, and they'll come from breakage in the big trends. A slot machine comes to mind. I've never played one, but you pull the handle and 3 oranges pop up. You're a winner, whatever. They have to be the same fruit. Well, if the long-term trend matches the intermediate and matches the short-term, oh boy, you've probably got something.
So are you taking stop losses as well when you're trying to build these
No,
positions, or this is
no.
strictly advisory, and we're not talking about you doing your own
It's
trading, for example?
it's strictly advisory, and I don't believe in stop losses as an arbitrary. I believe
Okay.
in stop losses if there's a structural reason. For example, let's assume you've got a long-term sell indication, a major structural breakage,
Okay.
and you enter at that point, short the S&P, let's say. And then that indicator is so broad that it's not going to provide you, let's say it's an annual oscillator, it might be 200-point move before it says something's amiss. So you can't focus on that. It's your green light to go in. Then you turn down to your lesser time scales, monthly or weekly momentum, and you control the ebbs and flows using that. And if it doesn't have a structural component, you don't put a stop order in to protect your position until and unless there's a structural reason to go the other way or to exit your existing position.
Right.
You don't just throw, I'm going to risk 5%. Well, that kind of arbitrary determination of a stop is effectively coin flipping. It's not discipline. It indicates a lack of a methodology to time where to get out.
Right.
You should get out when the market says, I'm going to go up if you're short, or where it says, I'm going to go down if you're long. And that would probably be a lesser time scale than your primary indicator. And so, yes, you can guide a trade with lesser indicators.
Okay, Michael, this is fantastic. I'll
Okay.
share for you a little bit about how some of these experiences. If you notice, some of these questions that I'm asking you are actually based out of strict experience. And, if I had to actually deal with a lot of these things, after that, what we'll do is we'll maybe talk about some of the trends that you're identifying as well.
Okay.
Because I know you've sent me a lot of your newsletters, and I'd like to cover that as well. But I think this is such an important. The name of the show is actually called the Big Trade Series, and you're one of the few people I'm actually talking to trading about. So this is fantastic. Having experienced a lot of this myself, I recently published a book called The Big Trade, basically covering market analysis from a quantitative approach. Because as we've kind of agreed upon is that fundamentals, despite using numbers, can also be very ambiguous, right? It's an interpretation. Either you're going to be bullish or bearish based on all of this, almost like a form of inductive analysis, right? You're inducting all sorts of different facts and figures to be able to determine, your stance on a particular, stock or ETF. And I've also experienced this more so with traditional technical analysis, in which you're also doing a lot of induction and sometimes curve fitting, and actually relying a lot on ambiguous forms of information. And the reality is, just like you indicated, is that the word technical analysis, I believe, is truly deceptive because it sounds like it's very expert and very truly technical and scientific. Yet, as you know, when you're looking at some of the data points that are being used to construct these free technical indicators, they actually can be almost very dangerous because most of them actually lag price to some extent. And as we've discussed about, is that price sometimes is indicating something else. And if you're not really familiar with the actual mathematics behind moving averages, MACD, stochastics, you name it, basically, then you're in trouble. And then there's the whole group of people that are using patterns like, wedges, cup and handles, all sorts of those patterns, which can also be extremely ambiguous. And what I've started to do, and what I cover in the book, is actually the form of quantitative analysis, right? We've actually do not use indicators. Rarely do we use charts. We actually look at stats and figures very similar to what you would see behind like a baseball card, or someone that's doing like Google Analytics, or someone that has a retail store that's quantifying shopping behavior and understanding probabilities of movements. We don't actually ever declare that markets are predictable. They're probabilistic. Things can happen, and as long as you try to position yourself in that manner, you can capture a component of that trend. One of the big things that we see are people can be very dogmatic, right? Fundamentally, especially about their views on certain things. As you know, we both know Doug Casey, and there's a lot of individuals that emphasize a lot of commodity investing or buying gold based on these structural fundamental situations. But sometimes if price is not confirming it, then you're probably better to follow what price is saying and then waiting for the fundamentals to concur with a particular view if it does take shape. So this is fantastic, the fact that you're sharing some of the experiences that you have and providing your own perspective to adding on top of traditional technical analysis. So that's why I really enjoyed this segment of that conversation. Maybe we can take it by also discussing about some of the trends that you're seeing. And you've sent me this newsletter about one of your great calls in China. And China is a great example of price moving before valuation. Equities have effectively doubled within the last year. What were you able to see, and what are your thoughts on China right now?
If you didn't catch the move already, don't try to catch it.
Right.
It's more than doubled in actually 9 months. July It broke out. I became obsessed with Shanghai, not Hong Kong now. We're talking Shanghai mainly. To some extent, they're different beasts.
Yes.
Shanghai did not behave like the developed markets. In 2008 and 9, it made a bear market low like all the developed markets. It exploded far more off that low in the first year than did the S&P or the developed markets. But then something happened. And, there's fundamental explanations for it. And I think primarily it's that the government did not overtly act to keep stock prices up. So stock prices in a staircase, relentless manner went down from 2010 through last year, middle of 2014, effectively almost going back to the bear market lows. Fundamental analysts, of course, were and momentum players were poo-pooing Shanghai because it was behaving so badly. Why should everything else is acting great, it behaves badly. And there are all kinds of bad stories about malinvestment in China, which I'm sure are all true. I had to ignore that.
Yeah.
Because technically speaking, one, the market was not inflated. It was deflated again, naturally. It went back to its lows on its own. That's step one. So it's just sheer pricing level. It cut itself in half again. Two, it was prolonged decline. Time is always a factor in allowing markets to find balance points. You don't find a balance point in a 6-week collapse or 6-week explosion. Sometimes it takes several years. But its momentum factors were clearly developing. If you looked at the price of Shanghai during the last several years of decline, it was just a relentless staircase down. I mean, there's nothing positive about it. But momentum wasn't. Momentum was building a massive floor with a very clearly defined level above each rally high that did not look anything like the price chart. And when I say momentum, I mean 200-week, 36-month, those type of long-term timescales. I was obsessed with Shanghai for probably 3/4 of a year, putting out reports on it maybe once a month, every couple of months, just simply noting what number does it take for the Shanghai in price to cause its momentum to break through the momentum base. And it would go up and tease the number and fall back and never break out. Finally, in July last year, when it cleared 2100, coming up underneath that, getting through 2100, all the momentum indicators blew out to the upside. The size and scope of the base was so huge. It was 3 years at minimum of width of the momentum base, which is sizable. When you have a big box like that or a big range and you break through it, it's far more powerful than if you had a range that was 3 months wide. And because the indicators I was measuring it against, the annual type scale, it was not only a long-term indicator, but the base itself, the width of it was substantial. You don't find these very often. So did I know Shanghai would double? No. Go up 50%? Sure, that was pretty much easy to tell. But it, in fact, more than doubled in less than in 3/4 of a year. And it came from a very discernible momentum base that a blind person could have seen 6 months before the breakout. And all you had to do was just keep monitoring and monitoring for the magic point. Momentum finally poked its head up through the top of the base. Meanwhile, the price chartists, they didn't have any such clarity. There was no such obvious point on a price chart that said, my golly, we've got something monstrous here. Similar thing happened last year with oil, the opposite direction, in the month of August. When oil came down through West Texas Intermediate through $96, which was still a reasonably high level. It had been in the 80s in the prior months and over 100 and so oscillating, in $30 range or so. But it came through $96 in the month of August last year. It broke about a 4-year wide support level on its 200-week oscillator and its 3-year average oscillator, both huge timescales. and also a very huge floor was being broken. So to see a collapse after breaking that kind of floor is not shocking. Again, if the scope of the technicals were only 3 months wide or 3/4 wide, it wouldn't imply the kind of potency that we got, but it was annual momentum breaking. So that's one thing I try to look for is not just whether something's changing trend, but on what time scale, and is the structure that it's breaking through awesome.
What are you seeing with the euro?
The euro collapse came last year in, I think it was early summer. I think I'd pegged it at around 136. And I frankly thought it would go to about 103, 104. That's a price-based reason for the 103, 104, and they bounced off that.
Yeah.
As far as the euro right now, I would yawn at the rally. I think the rally could sustain. I put out a report yesterday on it, several days ago. It was coming up through 110, and I thought you could go to 113 to 115. And I thought you might even hang in there until next quarter, meaning that this rally, though it may not go a lot further, I also have reasons to believe it might also hang in there. And be ringing in this 114, 113, 115 level as we get into the next quarter, which is some 40-some-odd trading days away. There's certain reasons for that. But no, this is not this upturn in the euro is a intermediate type thing, nothing of great significance. I'm more keen on the yen right now. The yen has a particularly good-looking potential. It's not behaving like the euro, but it has a potential structure that if you could get the yen, which I'm looking at yen futures,
Right.
They're in the 83, 84 area. It's yen per dollar, as opposed to the way the cash market's quoted. But the yen futures, if they get much up into the high 84s, and particularly above 86, I could see the yen run up into the mid-90s. And that would be a very upsetting event. It'd be a nice event for if you're long the yen, although it's really you're only talking 10, 15% move. Percent-wise, it doesn't compare to Shanghai. But it would be very disruptive to other markets, and that's one reason I'm keen on it. Is if the yen ever did that, it would be like a kid acting unruly in class. You know, you're not supposed to be doing that. It upsets a lot of central bank policies, and it upsets a lot of investment plans that are built upon the yen remaining subdued. So therefore, I'm keen on the yen right now in the Forex markets.
Are there any other trends that you're currently looking at that also seem interesting?
Yes, gold and silver. The near-term and intermediate-term action of gold is waffling. Mm-hmm. It goes from up to down, and it teases you. And I think a lot of people look at the $20 and $30 swings. I've identified some levels on gold that if it can get through, and these apply this quarter, specifically 1255, on a monthly closing basis. Well, that's about 4.5% or so above the market right now, 3.5% above recent highs. You ever get up to 1255, which on a price chart, if you look at it, doesn't really mean too much. But on momentum, quarterly momentum in particular, it is a massive monthly closing breakout. And silver has a comparable situation up in the low $17 area. We're right now below 16. So there's nothing to get excited about here except to know where the numbers are. Because if we get there, they look like bottle rockets. Now, if they don't get there, then you don't do anything. So that's one of the warnings of momentum. You know, you can see the structure. It's like a horse at the racetrack. You can see the starting gate. And until that gate opens, nothing started. But you can define the gate ahead of time and then move on and then just keep monitoring for effect. Another market I have a general view that commodities in general are in a bottoming process. Some of them are laggards like oil. But a lot of commodities got beat up very badly several years ago and basically abased since then. Sugar is a good example. Sugar has a massive momentum base on it. It's trading around 13 cents a pound right now. If you ever get up to about 14 and 15, I wouldn't be shocked to take it to 20 in a heartbeat. It has one of these big structural bases on it. And it sort of fits with the more macro view that I've got that developed market equity indexes are topping simultaneous with commodities worldwide tending to bottom. We've been through this before, called 1976 and 1977. The exact opposite handoff occurred, and of course led to the great commodity boom of the late 70s.
Michael, you've also written a book previously, right? And why don't you discuss a little bit about that and the premise of that book?
Well, that book is a political philosophy book.
Yeah. How did you go from technical analysis to political philosophy?
Well, I was going to be a political philosophy professor back when I was a kid, back in the late 60s, early 70s. And I wrote a master's thesis. I knew Murray Rothbard, who was a disciple of Ludwig von Mises.
Right.
And were not for Murray Rothbard and now the Mises Institute. That school of thought could have dwindled and been, on a back shelf somewhere, but he perpetuated it and made it quite large,
right,
and very influential now. And in fact, I would dare say that it is the greatest opponent to Keynesianism that exists out there. Is the other voice, which was not true 30 years ago. It was relatively unknown. And I was a student of Ayn Rand, of objectivism. Now, those two, on the surface, don't seem to marry up because Ayn Rand was very much a limited government advocate and was ardent on that. And she thought libertarians, quote unquote, were hippies, perhaps because some of them dressed that way. I'm not sure. But she had a very personal dislike for them. And Rothbard used to be part of her inner circle at one time, along with Alan Greenspan, who was part of the inner circle of Ayn Rand.
Yes.
And Rothbard was kicked out by Rand, I think on some religious reasons. Rothbard was married to a Catholic woman, and Rand, of course, was a non-believer. Anyway, they split apart. So there was both the idea difference between the libertarians of Rothbard, the anarcho-capitalist, and Ayn Rand being a limited government advocate. What I advocate in the book, which I actually wrote in the early 70s and only got around to publishing a few years ago, was the marriage of her basic philosophical principles on up to politics, but stopping it there and replacing her politics with anarcho-capitalist libertarian politics of Rothbard. And the fit to me is perfect. It is a complete philosophical system starting from basic philosophical principles all the way up to politics and economics. She was, I think, made an error in her politics, philosophical error. I think she was in love with the United States because she'd come from the Soviet Union. Right. And obviously the contrast must have been great to her.
Dramatic, yeah.
Yeah, and she just embraced basically the founding fathers as the be-all and end-all of political philosophy, limited statism. And I argue in the book that they can't have a limited state. You can pretend to. You could create constructs like checks and balances and all that sort of thing. But ultimately, they're just temporary road bumps toward a more total state. And I think to some extent we've proven that over the last 30, 40 years. But that's what the book's about, and very little reference to contemporary events, because it was written back then and I didn't add contemporary events to it. The only thing in it that pertained to economics was the distortions caused by central banks, which of course is part of the state, in terms of man's ability to measure, to make investment decisions. The distortion is caused by the central banks pricing money, the interest rate, where it shouldn't be or where it otherwise would not be, creating a lot of money. In other words, increasing the supply of the water in the swimming pool and so forth. So those cause distortions, and ultimately those distortions come back to bite you, as real estate proved in the last cycle. Anyway, and we've got our own version coming again, and I'm confident of that.
You mean in equities?
And I think this time around, it's not a real estate problem. It is not a bank problem. It is a central bank problem.
Right.
They've created a religious structure, a belief structure that people now bow down to and believe in. And once the disbelief, a wave of disbelief comes across investors worldwide, developed markets in particular, when faith is lost, panic can set in. And with the elevated equity prices now, even in Germany, the DAX has joined the party. Mm-hmm. The S&P clearly and the Nikkei all goosed quite high on the page, and certainly without great underpinnings of economic reasons, but very clear monetary reasons. Once that party ends, it could be nasty because that clearly was a distortion. And similarly, there's other distortions underway, too, and no doubt the government debt markets. We're already seeing, like, the German bunds get shellacked pretty good in the last few weeks with a good technical reason. So anyway,
I'm guessing when you're looking at your trading, you clearly have to separate that from your...
Yes.
Right. Okay, good. I don't even have to finish that sentence.
No.
You knew what I was going to ask.
Oh, for instance, the gold at 1900 in late 2000 and 2011. In early 2012, I had to turn major negative on gold. Mm-hmm. It didn't really break down until 2013, but annual momentum broke down clearly. Again, it's the kind of chart that I've showed you a gold chart then. You saw a market that was basically hovering. It might be a consolidation for another leg up, right? When a market goes up and then waffles sideways, it could be just a rest point. Right. But annual momentum was breaking massive floors. And so, by the spring of 2013, the floor came out in price. Okay. And we went from, 19, 18, 17, 16, 15, we went to suddenly in the 1100s. So I have to pay attention to that as much as of a gold lover as I am in the very long term.
Right. So that's the hard assets that you're owning, and then the trading is trading, and advisory is advisory, basically. I think you have to separate it into different worlds, right? Because if a lot of this school of thought would basically propose some kind of severe collapse in the financial system, and that would mean even the ability to trade, I'd imagine, in the future, right? When things got really bad, then they just basically banned shorting, right? And so you have to, I guess, divide up your investments into different classes or classifications.
Well, that's an astute thought, the banning of trading, but I don't know whether they could do that now, given that markets are across the world and they're not just in New York and and so forth. So, but I think
it could be very systemic, Michael. Right? It could be across the board, and you never know. If you're willing to believe what you're discussing, then that could be the crisis of all crises until the next one comes, right?
Yes, I think it's the crisis of central banks this time. They can't blame it on Lehman Brothers this time.
Right.
They really couldn't blame it on them then, but we'll overlook that for now. They won that argument, at least in the press, in the public opinion mind. But in truth, those failures were effectively government wave effect distortions that caused the banks to make malinvestments, particularly in real estate backed securities. That didn't come from their own rampant speculation. It came from government encouraging it, and then blaming them for it after the fact. But this time, the central banks have now beat their chest and said, "Look at us! Look at all the good we've done." So, in effect, they've put the boiling pot right in their own lap. They can't blame it on anybody else anymore. And so, this is going to be fun. And all I'm looking for as a technician is evidence that some movement in that resolution direction is occurring, and I'm starting to see the evidence.
Well, Michael, thank you very much for coming on to the Big Trade Series. Let's have you come on next time when you start to see more evidence on some of these issues and factors.
Well, thank you, Peter. You're a very astute analyst.
Thank you.
Good questions. Thank you.
We hope you enjoyed this mastermind session. If you'd like to contact Peter Pham or Phoenix Capital, please email info@phx-cap.com.